Alright, so in this video we're going to talk about whether investors actually care about sustainability efforts and maybe what some of those reasons are. Historically, investors were a little gun shy around these sustainability indexes that put too much weight on environmental social performance of a company because it was perceived to distract from the financial performance. That no longer seems to be the case. So very first, this is the number one strategy that's actually employed by most sustainability indexes across the world, and that's the active negative screening, or trying to exclude companies that have a bad track record for their performance on the environment, society, or maybe board governance. Is it associated with corruption, for example? So this happens a few different ways. One of the most common examples of divestment from companies that are perceived as risky is stock indexes or pension funds that don't invest in what are called sin stocks: alcohol, gambling, porn, tobacco, etc. Nuclear power is another example. That has now been extended to include companies that have a poor performance on the environment or poor performance in the communities where they operate. So with this picture here, you see this is Exxon Valdez, the Deepwater Horizon spill. Actually, coincidentally, what happened with this company is that in 2000, I believe it was in 2010, a number of ESG or environmental, social, and governance indexes had actually divested from British Petroleum because the company was perceived as having kind of lax environmental protocols, not or a lack of transparent reporting on their offshore wells, and that actually ended up being the issue, which really knocked this company when the BP Horizon spill happened. The stock ended up getting knocked down by about 50%. They lost $1 billion on their market cap. And all of the ESG or the sustainability indexes that had divested from British Petroleum beforehand were able to save themselves from being pulled down with the company, specifically because they had focused on risk. So here's an example. This is Morgan Stanley Capital International. So this is a very large global index provider with a kind of a sustainability slant on it. And they really heavily focus on ESG risks. This is a little bit of like a high level breakdown of how it would work, but you can see in the right hand column, a leading company, AAA status, typically will perform well on their financials, as well as governance reporting, transparency between governance, what's their track record on like corruption, as well as track record on the environment, track record on community performance and engagement with communities. As a company has more issues along its baseline, whether it's mismanagement of waste or water, poor emissions management, lapses in safety standard, and I believe I included evidence of board corruption, they will end up losing their grading on MSCI and then often end up being just excluded from the index altogether. Another driver for investors who are interested in getting into sustainability indexes, and I'm just going to move this picture down here, is a focus, understandably, on profits and profitability. Let's take a look here. Actually, I'm not going to watch this video right now. I'll share that with you in the notes. This is an example of the Dow Jones Sustainability Index performance. So this is an index that actually comprises global leaders from the top 10% of, I think, 2,500 companies internationally. And as indicated, as you can see on the graph on the left, the price return for the Dow Jones Sustainability World Index. Again, they're taking the top 10% of those companies that perform the best for environmental, social, governance performance, as well as financials. As indicated in this graph, over the last 10 years, yeah, here it is, 2018, this index actually outperformed the S&P Global BMI. I believe the 5-year annualized returns for the Dow Jones Sustainability Index were about 11.9%, so almost 12%, compared to the S&P's global benchmark index of about 9.8%. So investing in companies that perform well on the environment and society, they usually have the right people at the helm, often managing the bottom line as well, the financials. And then third on the list is, I would say, another another driver for investors that you need to account for, and that is values-based decisions. So this is kind of voluntary impact investing, which is another form of sustainability investing, but it focuses specifically on generating a positive impact, not just avoiding risk, not just building profitability, but also generating that positive impact. So an impact investment is basically focused on a company that is for profit and has an explicit kind of intent to improve social or environmental impact through their business model or practices. What you see right here, this Revolution Foods example, this is a certified B Corp in the States. And I'm just going to pull up the size of the company right now. So the lunch school, the school lunch market in the US right now is worth about $25 billion. This company is trying to disrupt that market because they provide more than 1 million of these snacks. And so these are supposed to be nutritionally balanced lunches that go to schools at a very low cost, while also just improving the nutritional intake of students, especially from low-income houses. This company has turned out to actually be extremely successful. Not only do they have a good social mission, trying to make lunches more nutritional for kids that are in marginalized communities, but they are also very, very profitable. I believe they're now valued at over $100 million. This is just in sum, like very quick breakdown of some factors, and I'll leave it to you to take a look at this, and I can provide some readings as well. But other factors why investors care about sustainability when it comes to investing, and why these sustainability indexes have been so common lately, is one, at the top, it mitigates and minimizes short and long-term risk, helps a company meet its legal obligations, minimizes reputational risk, minimizes bad PR. It ensures greater diversification. You can think of an oil and gas company now looking to invest more in renewables, which will save it during times like right now where oil and gas is actually negative. Avoid taking active country or sector bets. Again, that kind of follows on the diversification piece, and it also demonstrates leadership from these companies that are engaging more in ESG activities. So these, at a very kind of high level, are some of the drivers behind responsible investing. Of course, there are more, but I wanted to kind of go through all of these and really emphasize those first three. Thank you.